is Mary Paola Pariado, and I'm the tutor for corporate financial analysis. In this session, we'll be discussing the common size statement. So upon completion of this session, you should be able to prepare common size financial statements and also explain the advantages and disadvantages of common size statements. So just as we need a base for comparative analysis, common size could also be done within the company with competitors or also with industry averages, and will demonstrate how common size financial statements are prepared. So common size analysis is one of the tools among others that are used to analyze financial information. So in earlier sessions, we discussed the financial ratio analysis, the comparative analysis, and also the cash flow analysis. Specifically in this session, we are dealing with the common size analysis. So when you restate your financial statements in order to show percentages of total items with respect to a common base in order to make comparison, this is known as common size statements, and it's also known as the vertical analysis. Now there are several items in the financial statement, basically the statement of financial position and also the income statement. Now you'd want to compare certain items in these statements with respect to a common base in situations where you have to make inter-firm comparison or compare firms in the same industry. Now there is a number of procedures that has to be followed, and we'll take them one after the other. So when it comes to the asset side, you have classifications. We have the current assets and non-current assets. So you show the amount of these current assets and non-current assets individually, and then you find the sum of these assets. That will be your total assets. And now you take the total assets as a common base, and you find the percentage of that particular item in respect to that. So when you take the assets, you could have the total non-current assets divided by the total assets times 100, and you could also have the current assets, the total current assets divided by the total current assets divided by total assets times 100. Or better still, you could also find specific assets with respect to the total assets multiplied by 100. When it comes to the liability side, just as we have for the asset side, we have current assets. We have current liabilities, and non-current liabilities. And then you can find the total liabilities. That will be the sum of the non-current and the current liabilities. Now you can find each of them or each of the categories with respect to the total liabilities. When it comes to the income statement as well, it includes the following items: sales, cost of goods sold or cost of sales. You have operating expenses, net profits, interest, tax, and earnings after tax. So you'd want to calculate the percentage of each element in the income statement with respect to sales, and then that can be used for analysis. Now, what are the advantages of common size analysis or common size statements? Now, this helps in inter-firm comparison with a common base. So in cases where you have to compare two firms, or you want to make a comparison among two firms in the same industry, you have a common base that you can use to make that comparison, and that base could be in terms of total assets or total liabilities or the sales of each particular firm. And also this common size helps in vertical analysis of figures, in the sense that you can analyze each particular element in this statement with respect to a common base, and that can be used for intra-firm comparison as well. The common size statement also reveals the changes over years in relation to total assets, total liabilities, and sales. So you can know how much each of the items in the financial statement have changed over the years in relation to the assets of the company, in relation to the liabilities of the company, and also in relation to the sales the company has made over time. And the common size statement is also another way to show the relative efficiency of each cost item between firms when you are making comparison. Although common size statements have a lot of advantages, it also has its own demerits. And one is that it shows the percentage of each item in relation to the total for each period, but then it does not regard the changes of each item from one period to the other. So in cases where you have, let's say, cost of sales changing from 1 year or within 5 years, it's not revealed in common size statements, unlike the comparative analysis that reveals changes in each item from period to period. The common size only gives a percentage of the item in respect to the total for each period, but not changes of the item from period to period. And also, observations that are made using the common size statements may not always be useful because there's the possibility that there are more definite norms for the proportion of each item to the total. And also, in situations where there are no uniform costing system or the same accounting practice is not used by all firms in the industry, it would be very meaningless to have a comparative analysis or comparative positions of two firms. So you'd want to make sure that all the items or the companies you are comparing are from the same industry. And in as much as they are from the same industry, they are using the same or applying the same accounting practices and costing systems in order for you to make meaningful decisions. So in this particular session, we stated that common size financial analysis is also known as vertical analysis and also involves that key items of comparison that is used in this type of analysis: the total assets, the sales revenue, and also the total liabilities. So specifically for the statement of financial position, you have the total assets and the total liabilities as a key item of comparison. And with respect to the income statement, we have the sales revenue as a key item that is used for comparison. Thank you.